On a day, otherwise the markets are closed, and of course that could explain why we've not seen much movement of the Dow. The fact of the matter is they have made up a lot of ground. In fact, more than half the ground lost in that 6-day sell-off that started with a better than expected employment report for January. Europe's followed the same comeback trail as Asia, but interest rates are backing up, and that is raising some concerns for real estate, for housing in general, that loans are getting more pricey now. The National Association of Home Builders CEO Jerry Howard back with us. Jerry, perspective is everything. Maybe you and I can remember time rates were certainly prohibitively higher. But for a lot of folks who don't remember that, and even for those who do, this sort of breaks a sort of a 10-year complacency, doesn't it?
It does. Rates are going up, but it's interesting, Neil. They're going up in large part because the economy is growing. There's a little bit of a factor, I think, worry about the federal deficit, but the economy is growing, and I think that's what's forcing interest rates up, which is making us sort of look at it and say, we're not exactly sure how we should be reacting yet. We're not overly concerned. We're keeping our eye on it, though.
You know, one thing that was kind of interesting to me when I was looking at it is how many markets have come back from the housing meltdown. And then some actually heated up all over again in places in Florida, out at Silicon Valley, what have you. Are we in danger of seeing some of those overheated markets that got, to some people's overheated again, in danger of melting?
We're not so worried about that happening, Neil, as we are about housing affordability on the whole. And that's really driven not so much by interest rates at this point, but more by the combination of labor shortage, of increase in costs of building materials, and also the simple fact of regulations that were placed on the construction process throughout the past 8 years. Those three factors are really impacting markets more than anything else right now.
So you don't see, and you and I have discussed this before, but you don't see anything like what happened last time, where what began as sort of some hot markets and then extended to, any housing market, and the mortgage-backed derivative nightmare, and boom, 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 and all of a sudden it was a mass housing meltdown. You don't see that happening.
No, I think that if we get interest rates north of 6% sometime between now and the end of next year, and we don't see some correction in the labor markets, in the regulatory burden, then I think you could see the potential for a housing recession. But it would be caused by a lack of supply, not by the lax underwriting standards of the past.
All right. And so you don't see, by the way, a lot of people have made a big deal of that they are getting lax again, not across the board, but in some markets where it's not exactly what it was in the height of the housing boom, where if you just had a pulse, you got a mortgage, but close. What do you think?
No, I don't agree with that. I think particularly for that component of the market that drives housing, the first-time home buyers, that you still have probably a little bit too tough lending standards. I don't see any of the easing up that you're referring to.
No, I hope you're right about that, because too tough isn't tough enough sometimes. You don't want to be cruel about it. Make sure people who want to get a home, can afford a home, are able to get a home, but you don't want to go crazy. But let me ask you about what wins out here. Obviously, you talked about the improving economy that is leading to these higher rates. The tax cut's certainly a big help there. But what if the rates get too high? In other words, this is a battle royale, right? I mean, the more the economy improves, the higher rates go, the more they potentially could offset the benefits of those tax cuts. Where do you stand on this?
I completely agree with you, and if we get north of 6% as for a mortgage rate, then I think you're going to start seeing us get very, very concerned, particularly if
we're a little bit north of 4.5 now.
That's correct, and we expect there'll be another maybe 5 Fed rate hikes over the course of this year and next year. We expect that it'll end up still south of 6, maybe about 5.5, and we think that the market can take that. North of 6% with some of these other pressures on us, then I think you're running a real risk.
All right. Thank you very much. Good seeing you again. Jerry Howard, the National Association of Home Builders.